welcome to this fourth video in our Get Started video series. Here we'll explain what mutual funds are and answer the common questions that any first-time mutual fund investor would have. So far, we have covered the basics about mutual funds, why you should invest in them despite having FDs or PPF, and how to figure out if mutual funds are indeed the right product for you. You can access all these videos and many more relevant things for a new investor from the link of our Get Started webpage in the description box below. But if you have already made up your mind about investing in mutual funds and you are wondering from where to buy and how to sell and what are the costs, well, worry not. This video is for you. Keep watching. Let's start with an example. Suppose you've shifted to a new city and are looking to rent a house. But how do you know which properties are vacant? Do they fit your budget and other preferences? Doing it yourself would mean hunting many places, dealing with a lot of landlords, and would ultimately take a lot of your time and effort. All of this looks like a hassle to you, but is there a way to make it simple? Absolutely yes. That's when a broker comes into the picture and acts as a mediator between landlords and the people like you. A broker understands your needs and shows you handful properties that are likely to fit your requirements, and this simplifies your job of hunting a house, and in return you pay some fees to the broker for his services. Likewise, in mutual funds, there are distributors or brokers who help investors with mutual fund investing and complete the transactions on their behalf. In return, they charge a fee for their services. Such mutual fund schemes are called regular plans. On the other hand, you can also do mutual fund investing yourself without the help of a broker or a distributor by investing online. You can buy the mutual fund directly from the fund house's website or via various online platforms and mobile apps that facilitate their buying and selling. Payments can be made online by using net banking or UPI to complete the transaction. These mutual fund schemes are called direct plans. But an interesting difference is that unlike a property broker, here you don't have to pay fees to your mutual fund distributor directly. Wondering how? Well, for that, let's first understand what costs are involved in mutual fund investing. When you buy a mutual fund, you have to pay the fund company a percentage of your investment amount every year to manage your money. This is called the expense ratio. It includes the fund management fee, agent commissions, selling and promotion expenses, and other fees incurred by the fund. But this expense ratio gets adjusted from the returns generated by the mutual fund itself. In simple words, if a fund earns returns equal to 12% and has a total expense ratio of 2%, then as an investor, you will make a return of 10%. SEBI, the capital markets regulator, has fixed the upper limit at 2.25% that a fund can charge as an expense ratio. Now coming back to our previous discussion about distributors' fees, what happens is that the expense ratio of regular plans is higher than that of direct plans, higher by around 0.75 to 1% per annum in the case of equity funds. The fund houses charge you extra to pay fees to the distributor, that is, to the seller of the mutual fund as sales commission. So, an important point to note here is that your returns in the direct plans are higher than regular plans by the gap between expense ratios of the two. So, between regular and direct plans, which one should you go for? If you are a net-savvy, do-it-yourself kind of person, go with direct plans. They will give you more returns. But you'll have to do everything yourself, from buying the fund to keeping track and deciding the future course of action. If you find it unnerving to take complete control as of now, it may not be a bad idea to invest through a distributor in a regular plan, even at the expense of paying a bit more. So the difference between expense ratio of direct and regular plans might not look substantial to you in percentage terms, but the impact on your overall corpus becomes meaningful over a period of time. As you gain more knowledge and confidence over time, you can later switch to the direct plans and start investing yourself. The only word of caution here is to stick to your investment plan and not get persuaded by any other investment option distributors may offer you, as they have their own interests attached to it. That's all you need to know about buying and selling of mutual funds for now. We know you would have many other questions about going ahead with them. Well, worry not. Look out for our other videos where we answer similar and many other questions one at a time. We'll answer all of those in this series.